Safe haven investments traditionally offer investors protection in the event of market downturns. Recent events such as the banking crisis in the US and Europe and a rise in tensions between the US and China have led to a flight to safety by investors. And one of the most popular of these traditional safe havens is good old-fashioned cash.
Cash is still king. In terms of fluctuations, equity valuations have seen a bit of fluctuations. In the short term, cash seems much more valuable in that sense. I think dollar, the Japanese yen, and to some extent Sing dollar in the region as a safe haven currency in the region. But those currencies that we probably would try to avoid would be those emerging market currencies during periods of crisis.
The safest investment is always cash, but you have to ask the question of whether that money in the bank is actually still giving you the biggest bang for the buck. For a lot of banks, even though the interest rates that the Fed has increased, they may not be able to pass through the whole kind of benefits to the depositors.
With equities still volatile, safe haven buying has boosted the price of gold. Gold prices rallied to their highest level this year on April the 13th. That's close to the all-time high that was reached in August 2020. Prices have since stabilized, but analysts remain optimistic about gold's prospects.
I think in the next couple of months, we're quite confident gold may break the historical high that we saw during COVID 2070. And that's because I think the sentiment has improved a lot since February because of this uncertainty we're seeing in the banking sector, potential market shocks we're seeing, and ongoing geopolitical tensions between China, Russia, and the West has pushed up some of the gold demand by investors and also central banks as well. So our outlook remains quite positive because we do think if the Fed does pivot in the second half of this year, which we believe they might, that will be a very positive factor for the gold price to continue its momentum that we saw in Q1 of this year.
In a strong way to try to support the economy. So that's
the prospect of the Fed cutting rates in the second half of this year will also bode well for another safe haven asset, the bond market.
Typically, in times of stress, people move away from riskier assets and move towards the bond market in safe haven currencies or denominated government bond markets. So US Treasuries, JGB bonds, denominated Swiss franc government bonds as well, and definitely Sing dollar T-bill treasuries or SGS notes or papers. So those tend to be attractive as well because of the nature of the currencies as well.
There are also other conditions that could affect the value of traditional safe havens during market volatility.
Actually, bonds did not provide the protective characteristic that it was supposed to do in 2022. With interest rates rising so quickly, bond prices actually fell a lot. So last year, if you were invested into bonds, you would have lost money, and actually in similar magnitude as stocks.
Inflation was quite high last year, but gold was flat last year. So gold did its work last year, but it failed to register a positive return because I think the rate hike cycle was quite aggressive, and that had a negative impact on gold price.
Not all safe havens carry zero risk. Some of them may involve a case where prices can fall in the short term, but typically if you hold them to maturity for investment grade bonds or treasury bills or fixed deposits, the risk is minimal. But in the case of unit trusts, of course it comes with risk. The markets go up and down, and that can affect the value of these unit trusts. But to reduce market volatility impact on your portfolio, then what you do is you spread your investments out over time through a dollar cost averaging strategy.
As market conditions evolve, there are also new opportunities to look out for.
For example, if you have too much equities, now may be a good time to think about adding some of the more traditional safe haven assets. Short-dated treasuries is a very good place. Gold is also very good. And I think over the next few months, as the risk of recession kind of grows bigger, then longer dated treasuries may start to perform better as well. So that's more on the risk management side. The other side of kind of thinking about your portfolio is also to keep a diversified portfolio. And this becomes particularly important as US slows down. When we look at global opportunities, actually we see that there are some divergences in the economic cycle. For example, China is actually recovering from a economic downturn, which is kind of in contrast with the US entering a downturn. So adding some like Chinese assets or emerging market assets actually may help to kind of balance out the risk that in your kind of US-based investments.
Ultimately, the best safe haven may not be an asset, but a safer investment strategy.
The traditional word safe haven gives you the impression that you can only buy one or two asset classes that are completely safe, where returns are guaranteed, where capital is guaranteed. Now, given the current volatile market and given the sharp drawdown in the markets that we saw in 2022, opportunities are starting to arise. But it will be there for investors with a medium-term view of the markets. And the way you manage risk in a market like this is, essentially keep a diversified portfolio, put your money into perhaps funds, asset classes that will not see a big drawdown if something major happens in the markets, and also spread your investments out over time. In other words, buy gradually. Keep some dry powder, buy gradually. Do not try and time the markets and throw all your money into the markets at a certain point in time. And that's another way to, invest in the markets in a safer way.